Welcome to the Investing with IBD podcast sponsored by Vantage Point. It's Wednesday, August 11th, 2021, and I'm your host, Justin Nielsen. And once again, I'm joined by my partner in crime, Arusha Paris of O'Neill Global Advisors, the former podcast host, but joining me each week. He hasn't gotten sick of me yet. And as our guest today, we have George Young from Villere Company. Now, Villere Company has been around for 100 years with wealth management. And so George is part of the fourth generation. So we'll kind of talk about what his company has learned over its 100-year span out of New Orleans. Welcome to the show, George.
Great. Thanks for having me.
Absolutely. So on today's show, we'll be doing things a little bit different. We're going to talk with George a little bit about trends versus fads, why he focuses on small caps, the things he's learned. We won't get into his honey making hobby that he had a while back, but I just wanted people to know that that was something that was out there, as well as mountain climbing for George. And then we'll also talk about some of the stocks that are on his radar. And we will wrap it up with our third segment on the market and a few stocks with Arusha and I. So let's start it out. And George, tell us a little bit about, again, being in the fourth generation. The first thing that comes to mind is, for each generation, did you have like the people, the sons or daughters that wanted to do things differently and wanted to do it their own way? What did you learn from that process, or what has your business learned from that process?
Sure. So I've been here since 1986. So obviously our industry has gone through a lot of changes. Right. One of the things that I helped to do was to put in a mutual fund, which was a foreign concept. And we started our first mutual fund in 1999, the Villere Balance Fund. And that was an interesting tool because it really allowed those that didn't have our minimum to use our investment style. So our minimum is $1 million. We charge 1% on our separately managed accounts. We charge approximately the same amount for our Villere Balance Fund, but it allows people with a lower threshold to get in. So a $20,000 IRA, a gift to a grandchild, that sort of thing.
Right.
It really accommodated that sort of investing. It's a good way to diversify.
Yeah. So that was what you brought to the table, I guess, in a big way. Very different. Were there other lessons that you would say in terms of style? Did someone, have you always had the same style with this family business, or was it, oh, we're going to be growth oriented? Oh, you know what? Maybe we should switch to value, small caps versus big caps. Or has it always been, these are the lessons we've learned and we're going to pass them down from generation to generation?
Well, the interesting thing is, if you talk about the difference in styles, those are subtleties. Those were subtleties. If you go back 50 years ago, there was the use of the term value. There was the use of the term growth. But again, when you're talking about my great-grandfather that started this building and his son, my grandfather, they were trying to convince people just to buy common stock as opposed to bonds, because investing in common stock in the 30s and 40s was really kind of a new idea and very risky. Bonds were the way that people went. So it's funny, because the things that we think of now as being important concepts you need to distinguish, it was much more basic than that. It was very academic just to understand the difference between a stock and a bond. And then also a huge difference, and I came in about the middle of this, is holding paper certificates.
Right.
That's something that investors today aren't aware of. Bearer bonds, that's something you read about in movies. You don't see those anymore. Those were fading as I started in 1986. So I'm feeling like the old man of the investment generation here.
Right. And so now it's your uncle and your cousins doing this.
Yes.
Do you have the next generation set up?
Well, that's under discussion. How about that? Okay. It's an interesting niche. And
I don't want you to disclose anything and surprise.
No, I won't do that. A lot of that's unknown. But so far, it's just been guys. There could be a daughter, a niece, who knows, coming in here. Anything can happen. We're open-minded.
Now, George, you mentioned 86 when you started. Immediately, I started to think about 87.
Yes.
Talk about that experience. I mean, your first year and a half into it, and all of a sudden you have one of the most epic crashes in the markets. What do you remember of that?
I remember a couple of things. One thing is that back then, this was just before we got a Bloomberg or had some access to a terminal. And so we would have closes written on a sheet of paper. The closing price for stock was of paramount importance. And what happened during the day, you may or may not know what happened because the quotes weren't quite that easy to get, not like now when you look at it on your phone. But I do remember it was a Friday afternoon, and all of a sudden, this didn't look good for Monday. And I remember Monday was a total meltdown. But between Monday and Tuesday of that October of '87, it was just a bloodbath. But at some point, value makes sense and metrics make sense. And I think that's still an important theme in the market today. It was about 2 weeks ago on a Monday, matter of fact, where the market had a semi-minor meltdown, and a lot of the more fragile investors went running for the hills.
Right.
But value came back, and metrics were applied, and certain logic came into the market. And I think that's always important for investors to think long term.
Mm-hmm. So you do have this long-term focus, but it was interesting because when I asked you if you have like a target time period, you really kind of let things play out as they will, as long as the trend is working and your thesis stands. What kinds of things are you looking at to kind of build your thesis of the stocks that you're choosing? What deserves a spot in your portfolio? You mentioned that you talk to management, but what kind of metrics are you using to kind of get a sense of, hey, this is a company that may be undervalued by the market or has a lot of growth potential? Anything you could share with us?
Well, I think prior to looking at metrics, you want to look at what products or services a company offers. Think in terms of a moat. That term's been used before, but I think that's important. Patent protection, or some product that they have that just can't be replicated very easily, and or they've got a link to their customers, to those that they provide these services or these goods to. A great example of that would be Pool Corporation. That's not one of the three that we had discussed earlier, but it's interesting. They sell supplies, they're distributors of supplies for pools, and rarely do people fill in pools. And as we know, those of us who own pools, they always need maintenance. So this company is bigger than the next 25 competitors combined. Their margins are fairly thin, but they can deliver the product all the time. As they say, everything but the water. And that's what you guys do. It's a great business model.
Well, and bringing up that pool example, because it has been very interesting what the company's been doing, just consolidating that industry. Really over the last year or so, you've seen a number of other pool companies start to come out public, like a Leslie, right, and a Hayward and stuff like that. What are your thoughts about that? I thought that was just really interesting. And all of a sudden, a number of these other companies are now coming out public, and they want to almost challenge pool on their level.
Well, one thing about Leslie's, it's the second time they've been public, and I've been doing this long enough where I know these sort of
things.
Awesome.
That's awesome.
That's
I remember them.
And the others, remember, Leslie's is a pool retailer as opposed to a pool distributor, so a little bit different. So they've got front facing towards the customers, and their margins are a little bit higher, but their sales aren't quite as high. So a great company, don't mistake me. But again, what we've seen in the last year are two things. One, it's a great opportunity to go public. So if anybody's thinking of going to public, you got to get that stock out the door before the opportunities crash. Right. And then the other is it's been an interesting environment for nesters, let's call them, people who can't take the trip to Europe or whatever they might do with their disposable cash. So they say, let's improve the pool. Let's put in a pool, as the case may be. So companies like Pool and Leslie's have really had the wind at their backs in terms of driving sales, et cetera. There are plenty of other companies like that, but it's all, people have cash, or a lot of people have cash. I don't mean to say that cash is flush for everyone, but the consumer in general has a lot of cash and wants to spend it. And the usual way they've been trying to spend it has been blocked. So they're being creative and they're going to spend it one way or the other. I mean, this is America, and at the end of the day, and people are capitalistically driven, and they will spend.
Right.
No, it makes a lot of sense.
Mm-hmm. So this kind of gets into this idea of some of these trends. So, I mean, you were talking about, some of this could be, due to COVID. Some of this is, maybe there's generational things happening with some of these trends. Are there any particular trends that you're looking at right now? And, when we were talking before, you kind of said something about wanting to go for a trend with some sustainability as opposed to a fad. And maybe you can talk about how you can tell the difference.
It is a little hard to do. One of the problems right now is obviously we don't know when COVID or the Delta variant is going to end.
Right.
With that knowledge, then you can make some pretty obvious choices. What we try to do is to find companies that are undervalued, which is obvious. And so that means that what you might see in some of our stocks are some where the chart doesn't look so good, meaning a lot of people assume that if a company is hitting 52-week lows, that it's, quote, a bad company. And there's a big difference between a bad company and one that's undervalued. You've got to look at the underlying metrics, a ratio of the price to earnings ratio to the growth rate, for instance. You want to make sure paramount importance is good management. Who's in charge? What are they able to do? On the other hand, if it's bad management, are they going to be tossed out? But I'd prefer not to see a change in management. I'd prefer to see good people at the helm before we buy.
Mm-hmm.
Now that makes a lot of sense. And what about inflation? Just how is that playing into your analysis or your stock picking?
Well,
or more so inflation fears, I guess, right
exactly.
now.
Sure.
Exactly. Yeah.
Well, we tend to be bottom-up investors as opposed to top-down, and top-down investors are those that look at the economy, look at interest rates, try to predict which sectors are going to do well or which may have trouble. On the other hand, what we look for are companies that will do well in generally any sort of environment. So inflation is generally bad, but worse than inflation is deflation. And again, if this Delta variant stays with us much longer, we could have a deflated economy. And we really haven't had that in a long time. But students of economic history would agree that if you look at the Depression, really the only way we came out of that was through a world war. And it took us that long to do it. And I don't see war on the horizon, and I don't want anything like that, obviously, but deflation is very, very hard to tame. But that's where we are right now in terms of interest rates. And we see that worldwide. It's not just in the US. We've seen negative interest rates in Italy, in Germany, Japan for some years.
Yeah.
Right.
So we're not out of the woods yet.
Mm-hmm. Yeah. Okay. So you know what? We're going to get a chance to talk about some of these trends that you're seeing, and again, why you're seeing some of these stocks that are at 52 lows maybe, and what value you're seeing in them. So we'll do that right after the break. Kicking yourself for that early exit? You can prevent them, and it's easier than you think. Go to freestockcoaching.com to see the tool independent traders are using to perfect their trades: artificial intelligence. AI doesn't involve staring at your screen for hours, and no research is needed. Just pick a stock and press a button. Visit freestockcoaching.com to see a live demo now. You need to be ready for rapid market changes, and AI can help you avoid potential losses. Check out freestockcoaching.com to learn more. Trading involves financial risk and is not suitable for all investors. Past results do not guarantee future performance. Welcome back to Investing with IBD, sponsored by Vantage Point. It's Justin Nielsen here, along with Arusha Pires and our guest today, George Young from Villere Company. So George, let's talk a little bit about some of the stocks on your radar. And again, this is going to be a little bit different for many members of our audience. We'll go ahead and start with Paya. And this is Paya is the ticker symbol on this one. So Arusha will pull this up for me. And, you know, the first thing that I noticed is it had this, long period of not doing anything. It looks like it, had a nice move in 2020, and it's just kind of languished for a while since then. And of course, this is in the credit card payments, which a lot of people, of course, are talking about: PayPal, Square, these big behemoths. What attracts you to one of these smaller players?
Sure. Well, it's not just credit cards. There are also debit cards and ACH transactions.
Right.
And they're happy to do smaller transactions and also work with smaller players in that transaction business. So this would be nonprofits. This would be smaller merchants, that sort of thing. Their fees are particularly low, and the typical credit card fees are particularly high.
Right.
And transaction-oriented smaller businesses have been kind of left by the wayside. So this is something that Paya has glommed onto. They are able to serve 120,000 different merchants right now. And again, all of them are small, so there's no concern about one particular client dropping off, as you might have with some big businesses, an airline business, Boeing,
right,
for instance, that sort of thing. So they're poised for growth. Management is fantastic, been in place for a while. They just reported our earnings the other day. They're up 37% in terms of revenues. That's partly based on recent acquisition, but organic growth has been about 18% in revenues. It's a small cap company, and that's one of the problems with small cap companies is that they are somewhat underfollowed. So it takes a little while, and it takes some, show me who's boss before people jump onto it and understand what they're doing and buy into the stock. But that's the world we live in. We tend to be more small, mid-cap focused.
Well, and especially so just in terms of liquidity, this is roughly a $10 stock. It trades on average about 1.2 million shares a day. So maybe about 10 million in dollar volume. So you might not have some of the larger institutions in this. And so again, that does that ever get to a point where you find it a little bit harder to get in or build a position in a stock like this when there is less liquidity?
Yes, only every day. It's something we live with. It really is. It's really sort of strange because a number of mutual fund companies or a number of investment advisors really relegate themselves to the larger cap stocks because they want to be able to fill in positions effortlessly and without moving the market at all. So yes, we have to be very careful about that and to make sure that our clients, we manage about $2 billion altogether. So yes, it's the lower end of our threshold of what we can buy. But on the other hand, it's something that has the opposite effect. Once we've built the position and we expect that in due course they'll report good earnings, revenues, then that means the stock will be pushed upward. And that same lack of liquidity that worked against us works in our favor. So we respect that and we understand, and we try to take our time. Sometimes it may take us 20 or 30 days to build a position, but we have patience. And again, our time horizon is 3 to 5 years. So with that sort of time horizon, it's okay if it takes us a little while to build a position.
Right. And how many positions do you usually hold in your portfolio?
We're a little more concentrated than most, so we might have 20 to 25 positions in a given account.
Yeah, that's pretty aggressive.
It is.
Yeah.
Well, we tend to know the companies pretty well, and we tend to have a good dialogue with management. Now, again, as you might expect, you're going to get a one-sided story from management, but it's helped to understand what they do and how they perform. And it is good to have that relationship nonetheless.
Speaking of management, what about risk management? How do you, is there a point where you know where you're wrong? So a stock like Paya, you might have a 4 or 5% position in it. Is there a cutoff point where you're like, okay, this is, we have to cut it now. We have to start slowly getting out of it.
Right. Well, I think there are generally 3 categories that a sell position would fall into. One, if we buy it, and let's use the idea of 20 stocks per position. So we buy a 5%, it represents 5% of a client's portfolio. If we're lucky, smart, however you want to term us, and it ends up being a 7, 8, or even a 10% position, that's a good problem. We'll cut that back. Now we will cut it back. We're sensitive to capital gains rates, so we'll cut it back when we've held it more than 12 months as a general statement. So that's one event. The other event would be our thesis is wrong, and we have to own up to that at some point. What we thought was going to happen didn't happen, or sometimes there are exogenous factors that get in the way. The CEO dying of cancer, I think that happened twice with McDonald's. These things happen. And sometimes a smaller company might not be able to recover. Sometimes we're just wrong in our thesis and that's it. And then the third category would be where something does pretty well, but we see that there's a competitor or another investment that we prefer to have. So that means we have to make room for it. We'll sell that position or maybe even cut it in half and buy that other position that we think represents a better opportunity.
Is there ever a point in which you still believe your thesis is right? You still think that everything is good with the company, but the market just doesn't agree with you, And so, is there ever a point in which you might use just the price of the stock and say, we can't afford to, I guess, stay with this position because we're just losing money?
Right. Well, yeah, it brings to mind there's an old adage: stocks are seldom cheap and popular at the same time. So you have to balance that. We see in this bull market right now, a lot of stocks are, quote, popular, and some continue to buy them. They're certainly not cheap. And there are others, just the opposite, the stock price is doing terribly, but that doesn't necessarily mean that they're bad stocks, as I said earlier. And that's particularly true of these small cap stocks, where they're somewhat underfollowed. Wall Street doesn't necessarily follow them unless there's been a follow-on offering and they're indebted to an investment bank and they need to follow those. But lots of times that doesn't necessarily happen. So there's a lot of opportunity in small cap stocks. And again, that lack of liquidity, sometimes you have a big seller that comes in and needs to get out by the end of the quarter for window dressing purposes, and there's an opportunity to buy that stock. So we're always mindful of that.
Mm-hmm. Okay, let's go ahead and turn our attention to eHealth. The ticker symbol on this is EHTH. And this is another one that the market is certainly not rewarding this one at this point. It's 50% off of its 52-week high. And what is it that you're finding compelling about this story? I mean, it certainly has revenues about 100 million per quarter. So that is in place, but earnings have been a little bit spotty in terms of the growth. What is it that you see here?
Right. Well, the first thing to understand is what they do. They offer Medicare supplements. So
Right.
when a U.S. citizen turns 65, they're entitled to Medicare. Medicare is great, but there are a lot of things that it doesn't cover. So the vast majority of participants decide they need to get some form of Medicare supplement. So then it begs the question of how do they make that decision? So there are 11,000 people, 11,000 Americans turning 65 every day. So a vast majority of those are going to buy Medicare supplement. And if they do their research, that's great if they know what they're doing, but that's a rarity that somebody knows what they're doing. So eHealth hooks them up with the correct provider. And they've got 170 different carriers that they're involved with, and they're agnostic as to where somebody goes. And the decisions as to where someone should buy their supplement is based on where they live, what their health needs are, and what they can afford to pay. So eHealth has trained operators, I'll call them, because sometimes they go by phone, sometimes they go by internet, to market to these folks. To try and find them. There's an annual enrollment period every year in October, and that's the time in which you as a participant can change from your previous carrier and decide what fits for you. So the focus here is on what they call the churn rate, and the churn rate is a nettlesome sort of number because as the name implies, people get out of one carrier into another one. So what eHealth is trying to do is to make sure that they have a relationship with all these different carriers and to make sure they sell properly to that person that's buying the Medicare supplement.
Well, and as you said, this is not necessarily an easy thing to navigate. Personally, I was trying to help my father-in-law with some of the decisions, and I consider myself a fairly smart guy. And man, that is not easy.
It's mesmerizing.
I don't understand. Like, oh my gosh, this is something that a lot of people do. Like, really?
Right. Well, there's an interesting couple of wrinkles to this story. So, as you say, the stock price does not look good at the moment if you're a chartist, if you look at the technicals. Mm-hmm. On the other hand, what's happened is two activist investors have gotten involved. And they're fairly vocal, and as I think you both know, active investors are fairly aggressive. And then interesting, they also were able to borrow money on a preferred basis from yet another company. So they've got three involved parties who are going to take this very seriously. They've got board seats. So it ought to be pretty interesting to see what happens in this annual enrollment period 2 months from now. But we're enthusiastic. I think management knows what they're doing. I think they've got a good sales technique. And again, it's a difficult sale because the 65-year-old today is getting information from a large variety of sources, including their sons-in-law, for instance, and others
that don't know much.
It's an interesting sales technique, and one that's a little tricky. But sales by nature are somewhat tricky.
Where was this idea attractive to your firm?
Say it again. I'm sorry.
Where was this idea? When did it start looking attractive to you? So I'm assuming back in 2020 it was probably way overvalued for your metrics. But
Yep.
was it the last few months that all of a sudden it started coming up on your radar? And
Well,
that's where
technically, this is the second time we've been in this stock, because
Okay.
we bought into it approximately a year and a half ago. I think it was in April of 2020. And it was one of the unusual opportunities to sell it in, I believe, September or October. So where we sold on a short-term basis. Again, as I said before, that's a little unusual for us. We're predisposed to hold out for long-term gains. And then we got back into the stock about 2 months ago. Yes, I'm disappointed with what's happened so far. But on the other hand, as I mentioned, the activist investors getting involved, and then also this recent underwriting that was done by an outside investor, I think is going to prove very fruitful.
Yeah, no, because I remember that this stock has been interesting in the past. It's come up on my radar years ago.
Right.
Now the Ehealth seems to be the clear leader in this space too. I think,
Yes.
if I remember correctly.
That they do have competition, of course. But
Yes.
I believe they're the leaders. Yes.
Yeah, I mean, I'm just a brand name. I think that these guys have just kind of stuck out versus some of the other competitors
Sure.
that looked at in the past. Yeah.
Yeah. So let's go ahead and turn our attention to TTEC, and the ticker symbol on this is TTEC. And again, this is kind of still in that growth phase. The market is rewarding this one, and so is this one where you're starting to think about selling, or is this one where you're like, hey, this still has a lot of runway left in it, and could go a lot further?
We think it's got a lot of runway. It's interesting for a couple of different reasons. One, it is a growth stock. However, it does pay about a 2% dividend. Also, it's a little unusual. One of the reasons for the lack of liquidity is the fact that the founder, who's I think he's about 60 years old, he still owns about 60% of this company.
Wow.
So that's one of the reasons why there's not much float to the stock. There's not much liquidity, is because he owns such a large amount. That's a bit unusual. Now, obviously, as a founder, CEO, majority owner, we as investors are taking a little bit of a risk. What if he isn't there tomorrow? What if something happens to him? But on the other hand, having addressed that question, they have others who will be able to take his place because it's a large company and they understand that vulnerability. So we're satisfied with that. Now, one way to look at it also is that he has a high degree of conviction in what he's doing and what his company is able to do.
So you know what? Maybe let's get into that a little bit. What is it that they do?
Sure. So they're in the business of helping businesses, customer enhancement, customer engagement. So that's making sure that customers are satisfied to the beginning and the end of the relationship. So maybe a good analogy would be a car dealer. You buy a car from that dealer, and after that, they obviously make more money on the service component. So they want to make sure that the customer is engaged from the beginning, the appointments are properly set, the customer is properly thanked. Arguably, there's a bothersome survey that you get. Was the oil changed correctly, timely manner, that sort of thing. And hey, let's schedule your next opportunity to come in, service the car again. And hey, by the way, if you had a good experience, please let us know. Make sure that a friend can be referred for the service component or to sell a car. So I think that's probably the engagement that most of your viewers would understand, and that makes perfect sense. I think we've all answered those surveys before. And this is a company that's been doing it for some years, and they've been doing it successfully. So they have 150 different customers they work with. They're growing the customer base daily, and they're growing the customer relationships daily also.
And the revenue here, just so people that are not watching the video can see or understand, this is looking at about 500 million per quarter of revenue. And if you just kind of look at the growth numbers, you've got a lot of blue here, where the growth has been double digit for 7 quarters on the revenue side, and more than 8 quarters on the earnings side in terms of the growth, with some triple digit gains in their growth numbers just a few quarters ago. So definitely a big grower in terms of both the earnings and the revenue. So again, they must be doing something right, and this is one where the stock is being rewarded with a lot of price appreciation over the last year.
Yes, great.
Well, I mean, the first thing that I immediately think about is just the importance for any business on retention, and this engagement. The cost of a customer, a new customer, is always a lot more than keeping a current customer. So this does make a lot of sense, especially the analogy that George used right there, getting people engaged and keep helping them develop that habit. And so that is a really valuable service for a lot of businesses.
And are they targeting more small businesses or larger business, or does it run the gambit?
No, it's generally larger businesses.
Okay.
And that's a good question, because we talked about Paya before.
Yeah.
Their niche is really the smaller
Right.
businesses. No, TTEC, they want the big businesses. They want to help them retain the large customers, keep the database, et cetera.
George, what about some other competitors? Are there other major competitors out there that are really competing for those large businesses?
Not really. This one's a little bit unique, where it's a little bit unique. It's either unique or it's not. This is a unique business where there are not that many competitors, and that's made their sales process a little bit easier, where there are not many that are out there that can prove and they can demonstrate that the customer expertise and enhancement that they bring to the table has been successful and benefited directly to their customers.
Great. Well, George Young, I really want to thank you for being with us today. Again, George Young is with Villere and Company. He's a partner and portfolio manager there. You mentioned your Villere Balanced Fund. What is the ticker symbol on that for people that wanted to look into that?
Thanks for asking. VILLX, Villere Balanced Fund.
And then you also have another fund. What is the ticker on your other fund?
Villere Equity Fund, and that's VLEQX.
Okay, very good. So people wanting information can certainly go to your website, and we'll go ahead and make sure we post all of that information for them in the show notes, and also when we send this out on Twitter. So thanks again for being with us, George.
Great.
Yeah,
thank you.
Okay, and when we come back, we'll go ahead and take a look at the markets, Arusha and I, and kind of talk about some of this rotation that we're seeing under the surface. Why trade off hope and optimism when you can trade using the world's most powerful indicator? Artificial intelligence has been used by traders to navigate the markets for the past 3 decades. Visit freestockcoaching.com to see the world-leading AI forecasting software for yourself. Trusted by more than 32,000 traders, AI uses millions of data points to track market trends, giving you the support you need right now. Go to freestockcoaching.com and we will help you find great opportunities today. Our experts will show you what stocks are setting up for big changes right now. So head over to freestockcoaching.com for a free demo. Trading involves financial risk and is not suitable for all investors. Past results do not guarantee future performance. Welcome back to Investing with IBD, sponsored by Vantage Point. I'm your host, Justin Nielsen, and joining me is Arusha Peiris, O'Neill Global Advisors Portfolio Manager, as my weekly special guest star. And so, Arusha, let's get into the market. It was a little bit of a hit to growth today. You know, it's been taking a little bit of a break, but it's hard to fault it given the moves we've had in a lot of these stocks. But it just seems like we're, again, feeling a little rotation-y, would you say?
Yeah, I guess you could say that. It almost seems like it's par for the course.
Right.
You have a few weeks with the growth stocks, the tech-related stocks, having some really strong moves. And then you kind of go back to all the cyclical stocks starting to work again.
But just to be clear, I mean, the NASDAQ, it doesn't look like it's in trouble at all. I mean, it was down a little bit today. It's still trending above that 21-day moving average line. It keeps on touching it and, you know, finding support there, except for the one brief little jaunt it had below it at the end of July. So, you know, in terms of the indexes, in some ways, the indexes aren't really showing this rotation that's happening underneath.
No, usually when you see the indexes trending like this, our type of stocks, these tech-related growth stocks, are going through the roof. That's not necessarily the case this time. It's the indexes have masked what's going underneath the surface with all this kind of rotation going back and forth, and the market continues to be heavily news sensitive. And so whenever there's some good news or bad news about COVID or interest rates, or whether whether the real economy is going to be okay, or everyone's going to have to work from home for the next year, you have these pretty crazy shifts back and forth, and so that makes it hard if you are following more of a trend following system because if you hang around too long, and too long is not that long in this type of market, a lot of those gains that you might have had in a couple of days, I mean, a couple of weeks, you can lose in a couple of days.
Right. It's certainly easier to do trend following when the trend is lasting weeks as opposed to something you're doing on an intraday chart. So,
Yes, exactly.
oh, this trend lasted on a 30-minute chart and, then it was over in a few days. So how are you positioning yourself? Are you just raising cash while some of these growth names take a little bit of a break, or are you getting into some of these cyclical plays? I mean, we should just mention, like, for example, in the materials, I mean, the steel stocks have just been going crazy. I mean, Nucor, ticker symbol NUE, is one that we have on Swing Trader. That's had a phenomenal 3 days, and it's not alone. Steel Dynamics, STLD, is also in there. So again, you've got these were the stocks that were really leading from really November to while the NASDAQ was suffering, these were doing very well, and now it just seems like they're back in new high territory.
Yeah, the last couple of weeks, I've actually, instead of just, now normally a lot of times when my type of stocks go out, and I'm generally more tech biased than anything else.
Right.
Like, I understand those companies, that's what I kind of gravitate towards.
You can get excited about them too.
I get
excited
excited about
cool.
Them. Exactly. So tech ones or retail, those are the two that I generally do better at. But last week, or really the last couple of weeks, I've tried to force myself to get some cyclical exposure. And so both Nucor and Steel Dynamics, I have both of them because I didn't know which one is really better. So I bought a little bit of both. And so I do have positions of those. Unfortunately, they're not huge positions to completely make up for the losses that I've taken on the tech side. But what I decided like a couple of weeks ago was just more to try to have a hybrid kind of straddle and
diversify. Let's call it diversification.
I don't want. Well, diversify is still not diversify in position sizes or have 30 positions. Just diversify on industry exposure.
Yes.
And so really over the last few weeks, I've just started to notice more of these, especially the steel stocks. So it's like, okay, steel was in the top 5 industry groups. They had really strong prior uptrends before, in that previous run, and they were just consolidating, building bases. Now in the back of my head, there's a lot of doubt though. Like, could steel really keep going up? But this is where you kind of go and trust the charts and say, look, they have huge earnings, they have huge sales, they have great margins. And I mean, I have it on the daily chart here on MarketSmith, and all of these numbers are accelerating, right? They're getting better and better. So I just kind of went back to the system really and said, okay, they're not necessarily growth stocks, but they have great earnings, great sales, and strong prior uptrend. So let's start building positions in them. But I didn't. They
certainly have the CANSLIM qualities right now. EPS rating of 95.
Yeah, I was the composite rating of 99.
Yeah.
So so those were all going through my head, but I didn't have like the complete faith that I usually have because it's just out of my wheelhouse. So I just went a little bit smaller in both of these positions than I normally would. And I do regret that, because who would have ever thought that they would jump up so high like this? But that's where you just kind of have to, sometimes you just have to be there, right? And go and follow the system, follow the rules, because a lot of times your emotions can sabotage you. Right. And say, oh no, how could this work? And you can talk yourself out of this. At least this way I got some of it and didn't completely miss out on it like I usually do.
Well, and we should also mention that, again, it does feel like there has been news kind of tossing things to and fro. And of course, this week, one of the big news items was this infrastructure bill. I mean, we've known it's been out there for a while, but it's, a matter of it getting passed. And so one of the things that certainly was looking interesting, if we just take a look at XLI, which is one of the spider sector funds that, looks at industrials, and this kind of looked like, again, one of those things where it had been kind of taking its break. This had such a strong move at the beginning of the year and was really doing well when the NASDAQ wasn't, but then it didn't do much, and now it seems like it's coming back on a little bit stronger.
Yeah, Justin, it's funny. I actually bought this too today. where it was.
So I'm basically going through your portfolio.
You are. Yeah. I mean, did someone give you my login or something?
Right.
So it got through a little bit of a resistance area past that 104.50 type of level. And so I already had some of the steel stocks, but then you just start seeing more of these industrials start working. But I didn't know exactly what to buy. So I was like, okay, let me just get some exposure. So I bought a little bit of XLI just to get that while I figure out more of kind of who might be more of the leaders in the industrial space.
Well, certainly today, one of the ones that stuck out to me was United Rentals,
Yes.
URI. And, of course, you look at it and you're like, wait a minute, commercial services leasing. Well, they're renting some of this big equipment that people are using for construction. So that's why they get placed in that industrial space. And, this is one that's, coming right up to its old highs. It had earnings, that's out of the way, strong earnings report. We've been talking on IBD Live about Caterpillar, CAT, and Deere, DE, so both of those look like they're coming back. Deere is certainly in a little bit stronger position, whereas Caterpillar is just gotten back above its 50-day moving average line. But was there any other areas that stuck out to you?
Well, I was going to just first mention, you not only do you have access to my portfolio, you probably have access to my watch list too.
Okay, perfect.
I was looking, I nearly bought URI today.
Well, it's easy when you use password as your password, so.
But so I nearly bought URI today, but I just had to take a step back because maybe I should read about it a little bit more. But the reason why it was almost a spontaneous buy is because I just remember in the past, and let me just go to the weekly, maybe you could see some of the trends there.
Yeah,
I just remember URI trend that can trend really well. I mean, it trended well in 2020, but even years before, I want to say like back in 2010, 2011, URI just trended, it was 2012, 2013. It just trended a lot better than I ever imagined. So it's just one of those stocks that's in the back of my head that I know that the character of the stock can trend. So this is definitely something I'm keeping an eye on. Now, Deere had that amazing amazing end to 2020 and a start to 2021. So when you see such a strong prior uptrend there, I think it's natural to assume that, wow, this went from $100 and
doubled.
$160
Deere
up to
doubled.
Exactly, up to $400 or almost $400, more than a double. It's easy to assume that it can't keep going up, right? But in the end, none of us really know, but we do know where to get into them. And sometimes you have to just take those shots and see what happens. Now, the thing with a Deere is they're reporting earnings in 9 days. So it gets a little bit trickier, but if it does break out, it's forming this cup right now. If it were to break out in the next couple of days, you could potentially try it and hope that you get a run into earnings, so you have a little bit of cushion to hold into earnings.
Yeah, and we might as well just go ahead and mention, one of the other things that seemed to be getting our attention today was the home builders. XHB is a ETF that tracks the home builders. So that's also looking set up. And again, I don't blame you for being a little gun shy here, because again, with this rotation, what's happened sometimes is you'll have these work and set up, and they work for 3 days, and then it's like back to growth or whatever. So it can be difficult. But certainly two stocks that kind of caught my attention today were Lennar, ticker symbol LEN, and DHI. So Lennar was, of course, kind of coming out of that cup with handle formation, and DR Horton will look very similar, not quite as close to its previous highs, but still, crossing an area of resistance and looking strong for both of those. And again, it wasn't just these stocks; it was other stocks in the group that were also looking strong, and actually across a lot of the building sector.
Right. Now, I actually bought for XHB. I bought a little bit there just to get exposure for the home builders. Lennar is the one that I have been watching. I think I mentioned in IBD Live maybe a few weeks ago, and right before, I wish I bought it because right before it popped. But that seems to be the leader of the home builder group. So that's something I'm just keeping an eye on right now. But yeah, all these stocks, they're just kind of telling the story that, yeah, maybe this rotation's it might last a little bit longer.
Right.
kind of like the beginning of the year where these were the stocks that were able to trend pretty well. And maybe the tech stocks need to pull back and chop around a little bit more.
Yeah, and again, this is one of the things where, I mean, this market at least seems like when one group is, giving you those sideways moves, there's other groups that are kind of taking up the reins, and that's why we're seeing the indexes a lot of times push to new highs, even when it could be different groups that are leading that. And it just reminds me again of 2017 a little bit, because I feel like there was some of that rotation happening there. Whereas if you looked at the indexes, you didn't see it. The S&P 500 was, barely correcting much more than 3%. And so we'll see if we're in a similar environment. And I mean, we're taping this on Wednesday after the close. We'll see if this holds through tomorrow when we post, right? Because again, these trends have been changing so much.
Yeah, well, one thing that I've been trying to tell myself when I'm analyzing stocks, and this is something that I kind of drifted away from for years, was okay, put more importance to the industry group ranking. And I feel like at least for these last few weeks, that's led me more into the right direction by looking at steel stocks, which are in the top 5, and a number of these other stocks that I've started to slowly buy. They're more in the top 40 industry groups. I've placed more weighting on them versus where I just usually place more weighting on the stocks themselves. But it just, over this whole year, if you had stuck with 80-90% of your stock purchases within the top 40, you probably would have avoided a lot of the frustration and the chop and slop that I'm falling prey to this year.
Yeah, absolutely. I would say one little caveat that I sometimes will add to that is if I see a lot of stocks in a particular group, that are setting up, I'm like, oh wow, here's a cup of handle, and they're all in the same group. Even if that's a little bit lower in the industry group, I might take a look. Hey, is there a lot of stocks in that group, and maybe there's few leaders, but they're weighed down by the other ones. We were seeing some of that in semiconductors to a certain degree. You had some really big leaders, but then there were a lot of ones that just weren't doing that much. So that's one thing to kind of just dig a little bit deeper. But thank you so much, Arusha, for sharing your insights, and I guess sharing your portfolio in this case for today's action.
Well, I didn't intentionally share it.
Right, exactly. Well, thanks for making an easy password for me to crack and hack. It's always appreciated. And that's it for this week's Investing with IBD podcast. On next week's show, it's going to be a good time. We've got Chris Gessel, the Chief Content Officer of Investors Business Daily, and my boss,
the man.
Yeah, the man and my boss.
Boss.
So everyone, please send in good comments about me so that he doesn't fire me. That'd be great. So we will definitely see you next week. It's Justin Nielsen and Arusha Piras signing off. We'll see you next time. And for this week's notes and charts, make sure to go to investors.com/podcast, where you'll find details for each episode in the podcast episode section. And make sure to subscribe, rate, and review our podcast if you haven't already. We'd really appreciate it. You can also send us your questions and comments to investingpodcast@investors.com. We would love to hear from you and may use your comments on an upcoming episode.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube. If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.